Tilray is one of the most recognizable names in the global cannabis industry, known not only for its Canadian operations, but also for its ambitious plans to expand internationally. The company has positioned itself as a diversified cannabis and lifestyle brand that spans medical cannabis, adult-use cannabis, beverages, and wellness products. Its journey has been defined by aggressive mergers and acquisitions, most notably the Aphria merger, which created one of the world's largest cannabis companies by revenue. The goal of Tilray has always been to use its scale, brand portfolio, and global reach to be a market leader, once legalization expands in North America and Europe. For investors, the story of Tilray has been one of both promise and volatility. The cannabis industry has long been subject to sharp boom and bust cycles, fueled by shifting investor sentiment, evolving regulations, and changing consumer demand. Tilray exemplifies this, having seen its stock soar during periods of optimism about cannabis legalization and then plunge when earnings or political developments disappointed. Today, the company continues to attract attention because of its size, its diversification into adjacent industries like beverages, and its potential upside if US federal legalization becomes reality. From a fundamental perspective, Tilray is a company still in transition. Revenue growth has been steady in recent quarters, supported by strong Canadian adult use sales and expanding international medical cannabis demand. However, gross margins remain under pressure due to oversupply in Canada and aggressive pricing competition across the sector. Tilray has made progress toward generating positive adjusted EBITDA, showing improvements in operational efficiency and cost control. But net income remains negative, which underscores that consistent profitability is still a goal rather than a reality. On the balance sheet, the company carries a significant debt load, which management is actively working to manage. While liquidity remains adequate, the reliance on shareholder dilution to raise capital has been a concern, as new equity offerings reduce existing shareholder value. In terms of valuation, Tilray trades at a premium relative to its current earnings profile. But if the US market opens up, the stock could quickly look undervalued given its distribution networks, partnerships, and diversified brand exposure. Fundamentally, Tilray represents a speculative growth investment where upside potential is tied directly to political outcomes and execution on its diversification strategy. Looking at Tilray through a SWOT analysis lens provides deeper insight into its positioning. Strengths include its global footprint, scale advantages from the Aphria merger, diversified portfolio across cannabis, beverages, and wellness, and partnerships that provide access to US markets ahead of federal legalization. Its brands, distribution networks, and European presence give it a first-mover advantage in key international markets. Weaknesses include ongoing unprofitability, reliance on shareholder dilution, debt obligations, and the challenge of competing in a saturated Canadian cannabis market where margins remain slim. Opportunities are significant, with US federal legalization representing the largest catalyst. In addition, growth in European medical cannabis, rising demand for infused beverages, and wellness-oriented products give Tilray access to adjacent industries that could accelerate growth. Threats include regulatory uncertainty, stiff competition from both legal producers and illicit markets, macroeconomic headwinds like inflation and interest rates that reduce discretionary spending, and the inherent volatility of cannabis stocks. Tilray's position is therefore one of strong potential but meaningful risk, making it appealing for aggressive investors who can tolerate swings in valuation. Cash flow management continues to be an important challenge for Tilray. The company has had to balance the need for expansion with the reality of operating in a sector that is not yet federally legal in the US, limiting access to capital markets and banking services. To offset this, Tilray has diversified into alcohol and wellness products, including the acquisition of Sweetwater Brewing and other beverage partnerships. These moves provide revenue streams outside of cannabis and help reduce reliance on the slow-moving Canadian market. The company's strategy is clear: build a diversified consumer products portfolio that can leverage cannabis legalization when it happens, but also generate growth in the meantime from other categories. While this strategy makes sense, execution remains key. If cannabis legalization in the US takes longer than expected, Tilray's diversification into beverages and wellness could help stabilize results. But investors need to remain aware that cannabis is still the core of the long-term growth story. From a technical analysis perspective, Tilray has been one of the most volatile cannabis stocks since its IPO. The share price has seen extreme swings, from euphoric rallies when cannabis legalization optimism peaks to sharp declines when market sentiment turns negative. At current levels, Tilray trades near its multi-year lows, around the $2 to $3 level, which has acted as a support zone. This suggests that much of the speculative excess has been washed out of the stock. On the upside, resistance appears in the $5 to $6 range, and breaking above this level would indicate bullish momentum returning to the stock. Trading volume has also declined significantly compared to prior years, showing investor enthusiasm is muted, but this sets the stage for sharp spikes in volume and price if a legalization-related catalyst emerges. For traders, Tilray remains a high-risk, high-reward play, with opportunities for significant upside on momentum-driven rallies. The long-term investment case for Tilray is therefore a balance between patience and speculation. On one hand, the company has positioned itself well globally, diversified into adjacent categories, and built partnerships that prepare it for a US market opening. On the other hand, profitability remains elusive, shareholder dilution has been a recurring theme, and the cannabis industry continues to face regulatory uncertainty. The bull case for Tilray is clear. If US federal legalization arrives within the next few years, Tilray could see exponential growth and its stock could re-rate much higher. Its distribution networks, beverage partnerships, and brand portfolio position it to be a first mover in one of the largest consumer markets in the world. In such a scenario, the stock could rise to the $10 to $15 range, representing a substantial gain from current levels. The bear case, however, is equally clear. If legalization is delayed significantly, if competition in Canada and Europe intensifies, and if dilution continues to weigh on shareholder value, the stock could languish at current levels or even fall closer to $1, as investors lose patience. In conclusion, Tilray remains a speculative stock that requires investors to take a long-term, high-risk, high-reward perspective. The fundamentals are improving, but not yet strong enough to justify significant multiple expansion without external catalysts. The technical setup shows a base forming, but upside will require momentum and news-driven catalysts. For aggressive investors with a tolerance for volatility, Tilray could be considered a speculative buy with a bull case price target in the $10 to $15 range and a bear case closer to $1. For conservative investors, it may be best to watch from the sidelines until profitability improves and regulatory clarity emerges. Tilray's story is not finished, and for those willing to wait, it remains one of the most interesting speculative plays in the cannabis sector.